All right, let's dive into something interesting today. We're looking at Lion Asiapac, a company with a financial report that'll make you do a double take. Revenue is up by over 50%, but they somehow posted a multi-million-dollar loss. So, from an investor's point of view, what is actually going on here? Let's unpack it.
You nailed it, Alex. It's one of those reports where the headline numbers just don't seem to add up. You've got this massive growth on one side and this huge loss on the other. But that's where the real story is, right? It's always hidden in the details. So let's start with the good news. And it's really good news. I mean, look at this, a 53% jump in revenue for the half year. We're talking about going from about 9.4 million Singapore dollars to 14.5 million. That's a huge leap on the top line, the kind of number that definitely makes you sit up and pay attention. Totally. And it gets even better when you peel back a layer. If you just look at their main day-to-day business, what the accountants call continuing operations, they actually made a profit of $1.2 million. And get this, that's a complete turnaround from last year when they had a $200,000 loss. So the core business isn't just growing, it's actually making good money now. Okay, so this is the big question, right? This is the puzzle at the heart of the whole report. If your revenue is soaring and your main business is profitable, how in the world do you end up with a $6.4 million net loss on your income statement? It just doesn't seem to make sense. This is what we really need to dig into. And you know what? The answer is actually pretty straightforward. It all comes down to one big strategic move the company made. This isn't a story about sales collapsing or some deep-seated problem. Nope. It's all about a single, one-off event that completely changed how the books look for this period. So let's break it down. So that big event? It was the sale of one of their subsidiaries, a company called Compact Energy, or CSEB for short. Now, for accounting, when you decide to sell off a part of your business, you have to separate its results. It gets labeled a discontinued operation. And as you're about to see, basically every dollar of that big loss we're talking about comes from this one single sale. Yeah, and this little table from the notes section of their report, it lays it all out perfectly. The total loss from this discontinued operation was about $7.56 million. But look closer. The actual business, CESB, only lost about $157,000. The vast majority of the loss, over $7.4 million, is from the loss on disposal. That's the crucial part. The loss didn't happen because the business was failing, it happened because of the act of selling it. So, you're probably asking, why would selling something cause such a massive loss? Well, this quote right here is the key. The loss included recognizing $9.3 million in foreign currency translation losses. The easiest way to think about this is like cleaning out your attic. For years, the company had this Malaysian subsidiary, and as the Malaysian ringgit went up and down against the Singapore dollar, they had to record these paper losses in a special account. They weren't real cash losses, just an accounting thing. But the moment you sell the subsidiary, the moment you clean out the attic, the rules say you have to take all that accumulated junk and put it on your main income statement. So it looks like a huge loss, but it's really just an accounting cleanup. Exactly. So that explains the loss. Now, as an investor, the next logical question is, okay, with CESB gone, what's left? What does the new, leaner Lion Asiapac actually do? And more importantly, how well is it doing? Well, what's left is basically split into two parts. You've got the supply roofing solution business, and that is by far the biggest piece of the pie. It's bringing in almost 80% of the revenue. Then there's a smaller trading business, which deals in things like mining equipment. So it's pretty obvious where the company's real focus is going forward. And if you look at where the money is being made, the picture's even sharper. That core roofing business, that's the profit engine. It generated $400,000 in profit for the half year. The smaller trading segment, on the other hand, is actually losing a little bit of money right now. So really, the story of this company today is the story of its roofing business. All right, so the income statement tells this really interesting story of a big transformation. But that's just one part of the picture. What about the company's overall financial health? Is it stable? For that, we've got to look at the balance sheet. And wow, the first thing that just jumps right off the page is the cash. The company is sitting on $46 million in cash and cash equivalents. I mean, that is a very healthy number. It got a huge boost from the sale of CSB, and even after they gave some cash back to shareholders, they are left with a massive cash cushion. Now, you'll also see that their borrowings went up to about $6.4 million. But hold on, this isn't what you might think. This isn't panic borrowing to cover losses. The company is really clear about this. They took on this debt to fund working capital for their growing roofing business. In other words,
This is good debt. It's being used to fuel growth, not to plug holes in a sinking ship.
And really, this chart just sums it all up, doesn't it? You've got over $64 million in assets and less than $12 million in liabilities. So after all that drama on the income statement, the company is left in a really solid, very stable financial position. That's a huge plus.
Okay, so let's pull this all together. We've gone through the confusing headline loss, the big corporate sale, and the company's new focus. So if you're an investor, what are the key things you need to walk away with? What does this all actually mean? All right, let's bottom line it. First, that huge $6.4 million loss, forget about it. It was a one-time accounting thing from selling off a subsidiary, not a sign the business is in trouble. Point 2, the business that's left, that core roofing business, is not only growing, it's profitable. That's the new engine of the company.
Exactly. And number 3, that sale left them flush with cash, $46 million of it, which gives them a ton of options. Fourth, and I think this is a big deal, they gave $11 million of that cash right back to shareholders. That's a sign of a management team that's thinking about its investors. And finally, that new debt they took on, it's strategic. It's all about pouring fuel on the fire of their main business. So the big picture here is a company that's simpler, stronger financially, and laser-focused on what it does best. And really, that's a story any investor loves to see.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.